Hello, traders. It's Wednesday, the 18th of March, 2020. It's 8:02 a.m. Chicago time. Thanks for joining me again for episode number 1715. Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. This morning, as you probably already know, we are limit down on the S&P 500 and across the indices. The S&Ps are stuck at the 5% down limit at 2393.50. Another day, another limit. um, I posted the other limits on Twitter, and if you're a Convergent member, they're in the Head Trader channel. The 5% limit is 2393.50, which is triggered. The 7% limit, which would kick in right at the cash open at 9:30 exactly, 9:30 Eastern, would be at 2342.50, approximately 51 points lower, which is likely to be triggered as well, which would set off the New York Stock Exchange circuit breaker, which would put us in a 15-minute hold from the point the circuit breaker happens to the second, essentially. And then we have a 13% limit at 2191. Now, we have not hit the second limit yet. We generally bounce back up, but that's where we stand today. Again, the market is limit down today. Another day in this crazy kind of situation. The limit down is being attributed to the fact that, or the perception, I should say, that the intervention by the central banks is not likely to stop a deep recession globally. Um, uh, POTUS Trump is looking at $1 trillion relief package in addition to about 49 billion in additional budget for federal agencies. Um, I believe the Bank of England's president speaking currently. Prime Minister Trudeau is expected to speak at 9:15, I believe, 9:15 Central, 10:15 Eastern, and so on and so forth. I mean, all these figures are doing their best to slow down the damage that this could have on the economy. Of course, many companies are exercising social responsibility by allowing their employees to trade from home or trade from home, work from home, but there are many who have not. And so the expectation is lower productivity, lower earnings, and lower sales. And that means the earnings season is probably going to show lower guidance by various stocks and so on and so forth, and it precipitates. So that's where we stand. This crude oil has broken through the bottom of its balance zone. Crude is trading at 24.63, 24.63. Crude is down 9.88%. 9.88% down $2.70. Crude's taken a hit. Crude is actually rolled to May, which I need to update my charts on, has rolled to May. It's trading at 24.60 currently. Next come the Euro stocks down 129 points or 5%. The DAX is down 442 points or 4.96% from settlement. The Russell's down 51.6 points or 4.75%. The Nasdaq's down 328 points or 4.44%. The Dow's down 821 points, 3.94% down. The S&P down 92 points or 3.7%. Gold is also down, again, flirting with the 1500 figure, down $23.60. The bonds, interestingly, are down 2 handles and 20 ticks in the futures. And the 10-year note is down a handle and 2.5 ticks. The Bund is down 265 ticks or 1.54% on the futures price. The only thing that's up is the US dollar, which is trading above 100. The US dollar is 146.5 cents, up 0.66%. So, look, um, I can sit here and go over all kinds of stuff, but the fact is this: this is unprecedented. It's unusual. There's not much history to go by here. The market continues to respond to essentially fears and perception rather than fact right now, and it's going to continue to respond and panic. And I expect that since peak contagion is expected approximately 4 weeks out now, 4 to 6 weeks out in the U.S., and the infection numbers mimic those of Italy. My expectation is this is likely to get worse before it gets better. And I'm not an epidemiologist, and I'm certainly not a macro investor or researcher or anything like that. But to me, it just seems like we just started. If you recall, China has been dealing with this since November. And only now it is beginning to shut down hospital or medical facilities that were dedicated to coronavirus and sending those medical professionals home as cases drop off. Now, what's interesting here is whether or not their numbers start to climb back up as they open up the social constraints, uh, curfews, and basically martial law in across the country. Apple has reopened its stores there as more people get out. You know, sooner or later, it would seem, unless we have a vaccine, sooner or later everybody's going to get the coronavirus. It just becomes another flu. The real struggle here, and the reason everybody's isolating and social distancing is important, is to prevent the healthcare system in whatever country you're in from being overloaded by cases very, very quickly. So, so this is likely to be here a while. This is likely to flare up in the fall and next winter again, and it kind of needs to make its way through the global population, it would seem, before this kind of goes away. So I expect that the losses will likely be deeper. I'm not trying to state that there should be panic or anything like that. That's not my it's not my place. But it's not shot. You know, many friends are texting me or WhatsApping me or whatever, asking what they should do with their funds. And my answer, and I'm not a certified financial planner or anything. This is just a person who's just watching the market every day. My answer is it's probably wise. You know, those who want, you know, many want to deploy more money into the markets with a 7 to 10 year time horizon. And my answer to them, in my opinion, this is not professional advice, I'm not licensed to provide that. My opinion is to do so in the classic dollar cost averaging kind of method to bid out lower and lower and lower prices as the market is likely to continue lower and lower and lower. So we are currently at the price that we're at, where I believe we're off about 25% or 28% from the all-time high. And I think there's some room to the downside to go. So, you know, this is where we are. Now, I can go over all kinds of things like I normally do. There's a routine here. There's a habit to these trader bites, but it doesn't make sense in this sort of market. But I'll go over what I talked about yesterday, which is the expectation. You know, we were limit down yesterday or limit up yesterday right here. And I had talked about the idea that it is likely to push through this 48 and start working itself through this area up here, which was not correct. The market ended up pulling back on the reopen. Here it is. Ended up pulling back, pushing, and what it did is it put in a higher low to yesterday, to the prior low, the 2020 low. It put in a higher low and it pushed right up to 42.75, coming in very close to that last high, which I expected to be broken and for us to start walking up. That was my expectation. So it put in a higher low and could not break the high. So yesterday was an inside day technically, and it ended up resting in the upper distribution of the range, and it ended up being a normal variation day with the market, with the point of control sitting outside of the IB. This looked bullish to me. Leaving here yesterday looked bullish to me. It looked like it is likely to consolidate on the reopen and push higher. That's what I expected. That was completely wrong as the markets reopened and immediately tumbled to a lock limit down. Here's what it looks like on the order flow. This is CT Bookmap. You can find it at ctbookmap.pro. Here's the close. We reopen, and immediately in the Asian session, we go into some selling. We approach the lock limit down level, pull back, go right up to it. There are a lot of bids at lock limit down, of course, as folks try to get out ahead of it. And then we bounce back up, and then we hit it, and we have not been able to bounce like in other days. We have not been able to, hit it, bounce up, hit it, bounce up, hit it, and then kind of like I described before, like a ping pong ball bouncing against the floor. This has basically hit it and has been steady against the bottom of the chart here with very little trading. So it looks to me like it's very, very high probability that that's a 7% limit will trigger this morning. And we will be pausing for 15 minutes before we open again. There's not much more I can offer here other than to show you what the depth of market looks like, but the depth of market is influenced by the fact that we have this lock limit down. And I do have areas below. We are trading essentially December 2018. Below these prices, we're trading the prices at December 2018. Once we take out the low at in that 40, what is it, 50. Once we take out 2350, we would briefly be trading the low of 2018. And then below that, we would be going all the way to February 2017 prices, which consist of 10 to 12 to 13 point days and a lot of structure, a lot of fat profiles in that area. And as I look back to look for what areas I would be stocking, what stock zone areas would be in play in that scenario, it's difficult to see because the structure, those days, a multiple number of days could be covered by one rotation. Currently in the ES, one rotation is approximately 18 points on a 1 minute chart currently. So it's incredibly volatile. Currently, the close-to-close volatility over the past 20 days, the close-to-close volatility sigma is 122 points. In other words, from yesterday's RTH close to today's RTH close, it can move up or down 122 points and still be considered within the range, within the normal range over the last 20 days. I don't know if that tells you anything about the magnitude, but that's basically a lot. That's 10 times the norm, and it's continuing. Okay, so that's where we stand. There's not much we can glean. We do have some offers at 25.50 above, as I showed this book map, and then beneath there. Beneath where we are now, it looks like 23.20 has a bit of a bid, but that's really it. Again, the lock limit down at 7%, it's 23.4250, 23.4250. Whew. Anyway, Here's the big picture. This is the composite. This is RTH only. We are well below what we would consider to be value, which is currently sitting up 29.19 or so. We are testing this low from 2018 right here. We are stuck. This is where we are now. We had an impulsive move that pulled back, that became another impulsive move that pulled back, that is becoming another impulsive move, and this is why I expect a um, continuation below here. So it's there's no reason for me to think that, hey, this is pretty much done. If you're looking long, you may get you may get that relief rally after we've had the limit down like we've seen, but the better trade is to monitor, is to stock for the short side. Okay, the next big area down is right in here, which is in the 2050, 2030 region. That's the next big kind of balance zone is this one right here. Again, that's 2030 to 50 below. That's about 340 points away. Okay, so that's where we stand there. What are we expecting for today? Look, I've said this every day this week. There's just no point for me to sit here and draw lines on the chart. All I can do for you is I treat everybody I talk to about trading as if they are my own prop trader, somebody who's trading for me. And I'm going to tell you that you watch your risk. This is the kind of environment where you don't want to be stubborn. Doesn't matter if you got out at your stop and the market came back and you would have made money. It doesn't matter. That's not your trade. Your trade is your trade, and your trade is defined and is encapsulated by whatever it is you want to risk for this particular trade to see if the market's agreeing with you, whatever your target is, and whatever your bias is at entry, and that's it. So you know once the trade kind of stops out, it stops out. A stop out is not a bad thing because it frees you up to look at the market with fresh eyes. As long as you're holding on to a trade, if you're long and the market's falling and you're not respecting your stop, you're trading way outside the path to success, in my opinion. And it means that now your mind can only process and can only focus on what could save you. And what could save you in that situation is to find another area to lean against to buy some more, right? Because you don't want to experience the pain of closing the trade and booking that loss. But the fact is, this is futures. The loss is already booked. It's booked with every tick. There's no way around it. So take the loss and reassess your bias, reassess your trade, your stop, and so forth, and take the next trade. That's what's going to save you. What's not going to save you, in my opinion, is trying to salvage a trade that's already gone bad. This is not options. You cannot improve your position by putting on a spread or whatever. Your only job here today, is to find the direction that the market wants to go in your time frame, and find an entry that gives you um, an advantageous or an edge on that bias, and you're willing to pay, and you're determining what price you're willing to pay to find out if you're correct. That's what we do. You're looking for, how much do I need to pay? What's the minimum price I need to pay? That's the stop. What's the minimum price I'm willing to pay to find out if this very next trade is in alignment with the market? Not if the market is agreeing with me. The market doesn't care about you or me. It's you looking to be in alignment with the market, just like a surfer is in alignment with the next wave and can ride it. That's all it is. Okay, this is the holy grail here I'm giving you. And how you structure that, there are a billion ways to structure these trades, and that's not as important as the fact that you are following your plan and not sitting here gambling and out of boredom giving away your trading account. So you're not here when more opportunities arise as the volatility dampens and the market takes on the next whatever, the next iteration of what it is. Good luck today. I'll leave you with those thoughts. Please be mindful of your risk and also be mindful of your social responsibility to stay at home if you're asked to do so, so as not to spread this nonsense around unnecessarily. Good luck, and I'll catch you tomorrow. Take care.